SpaceX dropped 1%. Lab scores at 55 out of 100. Hold. The company's path to a sustained valuation hinges entirely on converting its Starfall program into concrete military contracts by Q4 2026. Without this critical defense revenue, the upcoming lockup expiry will drag shares below $145. Our full teardown reveals the engineering bottlenecks behind this high-stakes aerospace pivot. SpaceX sits as a Tier 2 beneficiary in the AI supply chain, the AI compute infrastructure layer, currently in a rising phase. SpaceX's hardware position is a competitive strength because its Falcon 9 boosters, like B-1078, have achieved an unprecedented 29 reuses, directly slashing the marginal cost of orbital access. Wall Street often misses that this extreme reusability is the physical moat enabling new, complex services. Consider the Starfall re-entry capsule, which just completed its debut flight. This isn't a complex human-rated vehicle like Dragon. It's designed as a 3.1-meter wide, 0.75-meter tall disk, weighing 2.1 metric tons empty. Its purpose is singular: return up to 1 metric ton of cargo from orbit. This specialized design choice is critical. Stripping out human-rated systems, like redundant life support, extensive crew interfaces, or complex abort sequences, significantly reduces mass and manufacturing cost. Starfall uses compressed nitrogen thrusters for attitude control, allowing precise aiming of its heat shield during re-entry. This is a simpler, lighter system compared to the hypergolic propellants and complex engine arrangements often found on crewed capsules. The entire recovery sequence is streamlined for cargo: a single main parachute for deceleration, followed by a Pacific splashdown. This focused engineering allows for a lean, high-cadence return capability. The real breakthrough, however, isn't just Starfall itself. It's the economic engine behind it, the Falcon 9 booster. B-1078's 29th successful flight on this mission means the hardware to put Starfall into orbit is incredibly cheap on a per-launch basis. This reusability is precisely what makes a fleet of pre-positioned, deorbit on-command capsules economically viable for rapid delivery. It's like an orbital UPS drone, but instead of a quadcopter, it's a heat-shielded puck dropped from 400 kilometers, enabled by a rocket that flies like a commercial airliner. This reuse cadence, averaging one flight every few weeks for some boosters, is what legacy aerospace competitors simply cannot match. United Launch Alliance's Atlas V and Delta IV rockets are expendable, meaning each launch requires a brand new, multi-million-dollar booster. Even newer, partially reusable systems like Blue Origin's New Glenn are still years from demonstrating Falcon 9's operational reliability and flight rate. SpaceX has transformed launch from a bespoke, expensive service into a high-frequency, low-cost utility. This shifts the entire market dynamic. Starfall, as a cargo return system, capitalizes on this. The company can now offer point-to-point delivery of critical cargo through space on rapid timelines, as per FAA filings. This capability, built on cheap orbital access, positions SpaceX to capture new revenue streams beyond just delivering satellites. The market, in its current 1.0% daily dip for SPCX, is still underpricing the long-term leverage of this engineering reality. While Wall Street sees a space stock with a high valuation, the lab sees a vertically integrated logistics platform where the marginal cost of adding new services, like Starfall, is dramatically lower than any competitor. The physical limits of reusability, how many times a booster can fly, directly dictate the economic viability of these new ventures. SpaceX's 29-flight record on a single booster is a hard engineering fact that underpins its entire future growth trajectory. This is not just a business model, it is a physical moat. Quarterly financials showing modest revenue momentum for SpaceX. By Q4 2026, normalizing monetary policy and structural capital constraints will compress SpaceX's forward valuation multiple by 25%, despite its steady 15.4% revenue growth. The macro environment is not a passive backdrop. It is a violent, capital allocating force. While the market celebrates the post-IPO price of approximately $156, the underlying mechanics of debt are shifting. The Federal Reserve holding rates at 3.63% means free money is dead. The yield curve normalizing has pushed the 10-year yield to 4.41%. For a company running capital-intensive development, this rate environment is a massive gravity well. With a calendar recession risk of 8.8%, capital is fleeing speculative assets. This explains why SpaceX recently tapped the debt markets for a reported $25 billion bond sale. It needs non-dilutive cash to fund Starship before liquidity dries up. Yet, the floor of this business is anchored by a massive sovereign buffer. Over the last 12 months, U.S. spending data shows SpaceX secured $9.6 billion across 25 federal awards. This includes $6.62 billion from NASA and $2.97 billion from the Department of Defense. This government backlog is a recession-proof shield. This includes the massive $3.04 billion NASA contract for lunar lander development and a $3.03 billion commercial crew award. When the Air Force funds programs like the $387 million National Security Space Launch Phase 3 Lane 1, they are buying strategic dominance. This capital does not care about high interest rates or consumer confidence. It is locked-in, non-discretionary federal spending that acts as a structural floor for the company's valuation. It proves that SpaceX's real customer is the state itself. With unemployment at 4.3% and CPI inflation at 0.6% year-over-year, the Fed is leaning toward fighting inflation with future increases. This signals that the cost of capital will remain restrictive. But this sovereign shield double edges into a geopolitical lightning rod. Global trade is fracturing under the weight of renewed tariff uncertainty and trade war fears, specifically driven by recent threats of trade conflicts over Greenland. When trade policy shifts, it directly threatens the aerospace supply chain. Raw material costs can spike overnight. SpaceX's beta sits at exactly 1.00. This indicates the stock will feel every macro tremor. Consider the escalation. Headlines of smuggled Starlink systems in Iran highlight the geopolitical complexity of global satellite networks. SpaceX is no longer just a launch provider. It is an instrument of national power. This geopolitical friction is amplified by the military's pivot to space. The Department of Defense is increasingly treating space as an active warfighting domain. This is why the Air Force is backing point-to-point cargo delivery concepts to bypass traditional shipping choke points. While this opens a new revenue stream, it cements SpaceX as a primary military asset. This exposes the company to intense regulatory scrutiny and foreign retaliation. Furthermore, the looming lockup represents a massive supply overhang. When early investors gain liquidity, a $2 trillion valuation faces its ultimate test of private market demand. At the same time, public policy is shifting. Bipartisan scrutiny over defense spending and tech monopolies is rising. The public market demands audited transparency. SpaceX currently lacks this as a newly listed entity with no audited public quarter yet. As inflation pressures persist with CPI at 0.6% year-over-year, labor cost dynamics for elite hardware engineers remain elevated. This squeezes margins just as the company attempts to scale Starship. Wall Street sees a triumphant space pioneer. The lab sees a high-multiple infrastructure utility navigating a high-rate, high-tariff geopolitical minefield. The macro wave is transitioning from an accelerating tailwind to a friction-laden headwind. Investors who ignore these structural realities are flying blind into a massive liquidity event. SpaceX, AI compute infrastructure, is trading below its 20-day average. Management's headline: we will use net proceeds to expand AI compute, launch infrastructure, and satellite capacity. Three buzzwords that make investors picture a soaring, cash-rich rocket while muting any thought of cash flow risk. The CFO's 8K sign-off is a legal shield, not a performance promise, and the pros is designed to keep the market focused on growth ambition rather than the looming need to fund it. The lab flips that script. No insider trades appear, so the usual red flag of insiders cashing out is absent, but the silence itself is historic. Every post-IPO filing from comparable megacaps shows at least one insider filing within the first 30 days, a pattern that usually precedes a liquidity squeeze. The EPS signal is a blank. There is no earnings surprise data because the company has not yet reported a public quarter, a data gap that forces investors to rely solely on management's narrative. Wall Street positioning tells a different story. Susquehanna set a neutral target of $170, while Oppenheimer pushed its price target to $250, creating a wide analyst spread. Yet ARK, the most vocal growth champion, trimmed its ARKK stake by 45,848 shares, signaling that even the firm's own bullish camp is pulling back. Short seller flow is flat at 66.9% of volume, matching the baseline and offering no fresh pressure. But the absence of a spike means the market isn't being punished for any hidden weakness. The engineering reality counters the PR gloss. The $74.4 billion net proceeds are earmarked for high-density compute and launch upgrades. Yet the only hardware that has actually moved is the Falcon 9 booster beat 1078 on its 29th reuse. An impressive reuse count, but a single-digit cost saver compared with the multi-billion-dollar spend needed to build a trillion-dollar AI satellite constellation. What management is saying is a grand expansion plan funded by a massive cash infusion. What the lab hears is a financing gamble with no near-term earnings data, a trimmed ARK position, and a hardware pipeline that still hinges on improving satellite compute density. The quarter's language shift is stark. In the IPO prospectus, the company splashed AI 891 times, launch 840 times, satellite 595 times, to underline exponential growth potential. Filing pairs down to expansion of AI compute infrastructure, without quantifying the multiplier, a retreat from the hypernumeric bragging of the prospectus. The CFO's 8K contains the standard forward-looking disclaimer, but the 10Q risk factors, still pending, will likely flag substantial uncertainty regarding the timing and scale of revenue from AI compute satellites and dependence on government contracts for a significant portion of cash flow. Those risk statements are the auditor's red flag version of the same optimism the press release tries to gloss over. The shift from bold multiplier language to vague expansion hints at an internal acknowledgement that the massive revenue assumptions may not materialize on schedule. Watch for the next 10Q line item titled Revenue from AI Compute Satellite Services falling short of the projected $1 billion threshold. If the disclosed revenue is below that mark, the bullish thesis that the $74 billion cash pile will be rapidly turned into high-margin AI satellite cash flow collapses, and the bear case, overvaluation and financing risk, gains traction. The lab's verdict. Management's PR paints a picture of limitless growth, but the hard data, insider silence, ARK trimming, and untested hardware pipeline tell a story of a $2 trillion market cap built on financing bets, not proven earnings. The momentum breakdown for SpaceX. RSI sits at 50, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. SpaceX's path to a sustained $2 trillion valuation hinges on Starfall converting into concrete DoD logistics contracts by Q4 2026. Otherwise, the lockup expiry will drive shares below $145.35. The bull case rests on two pillars. First, SpaceX's unparalleled reusability, exemplified by Falcon 9's 29th flight, provides an unassailable cost advantage that allows it to monopolize global launch. Second, Starfall's debut opens a new, high-margin defense logistics revenue stream, leveraging this cost moat directly into government spending. Starlink also provides a massive, growing cash flow engine for future projects, solidifying the vertical integration. But here's what breaks the bull thesis. The $2 trillion valuation on an estimated $14 billion in revenue, a staggering 145 times sales, prices in Starship and Starfall successes that are not yet realized. The lockup expiry presents a significant supply overhang from early investors. Furthermore, the lack of audited public financials means the true profitability and cash flow remain opaque to public investors. The wide analyst dispersion, from Seedfar's SL rating at $115 to Oppenheimer's $250 target, highlights deep market skepticism. Even Cathie Wood's ARK funds trimmed ARKK by over 45,000 shares, signaling some institutional de-risking. Given Starfall's successful debut, how quickly can SpaceX pivot from demonstration flights to securing multi-year, multi-billion-dollar DoD logistics contracts for point-to-point delivery? And what specific language in future SEC filings will signal that conversion? The lab watches for specific contract awards and dedicated revenue line items. SpaceX's public framing emphasizes commercial orbital manufacturing and rapid delivery. But the real signal will be explicit DoD budget allocations to the rocket cargo program and direct mentions of Starfall in national security space launch contracts. The shift from demonstration to operational deployment is the critical trigger. The lab previously moved to a hold at $165.55. The current price of $153 confirms our cautious stance. If Starfall secures its first multi-year, $500 million-plus DoD logistics contract by Q4 2026, SPCX could retest its $225.64 all-time high, driven by validated revenue expansion and market confidence in the new business line. If Starfall remains in its demo phase without firm DoD commitments, the lockup expiry will likely push shares below the $145.35 support level as investors reevaluate the valuation. The lab holds a neutral position. The AI score of 55 out of 100 reflects this balanced risk-reward. We need to see specific DoD contract announcements. Here's the macro picture shaping SpaceX. High Federal Reserve interest rates increase the borrowing costs for building massive satellite constellations, while new U.S. tariffs on imported aerospace-grade titanium directly raise manufacturing costs for rocket hulls. At the same time, growing military tensions in Eastern Europe and the Pacific are forcing the U.S. government to fast-track defense contracts for secure space communications, which directly boosts the company's military launch revenue. The dominant trend is the transition to fully reusable megarockets, which act like high-frequency commercial airplanes by slashing the cost of delivering cargo to orbit to a fraction of traditional expendable boosters. While legacy defense contractors struggle with single-use designs, this rapid launch capability allows the company to monopolize the global satellite market and starve competitors of vital launch revenue. Over the next 6 months, the biggest growth driver will be the first fully operational orbital flight of their next-generation heavy rocket, which will instantly double their satellite deployment capacity. Conversely, the most critical risk is a potential launch pad accident during these trials, which would trigger a lengthy government safety investigation and freeze all commercial operations for months. SPCX just flashed its tightest 20-day Bollinger Band squeeze in 2 years. That's the signal we trade on. Is SPCX a buy and hold or a trade? Comment your time horizon below. This isn't financial advice, just the lab's take. Markets change fast. Do your own research, and remember, past performance never guarantees future returns. We're here to give you the data, not a hot tip. Hit subscribe so you don't miss the next High Sigma setup. If you want our full breakdown on Intel, the link is in the description. Stay sharp, engineers.